Let's look at some common stock trading terms. By learning these terms, you'll become an exceptional trader. Save this video for future reference. That way you can always come back to this and figure out what exactly you're looking at in the markets. First, let's talk about trend lines. A trend line is a line drawn across swing highs or lows to show the direction of a trend. As you can see in the image below, we've identified a black line going up and to the right as a potential uptrend. We have arrows listed as 1, 2, 3, and 4. The first two arrows are red because anytime you're trying to see if a trend line is valid, you need at least 2 tests previously before determining if the next touch is a positive trend. So, the third touch comes in green, and we have a green check mark because buyers stepped in at that trend line and price went up and to the right. It also came back down to the fourth point here. As you can see, buyers stepped in again and the price continued to go up and to the right. This trend line is valid until the price closes below that black line. So, remember, you have to have a trend line test 2 times before you can look at the third point to see if it's a valid trend, whether it's an uptrend or a downtrend. Next, let's talk about support lines. A support line is a price level where demand prevents price from falling further. The image below shows a stock chart where we have a golden line drawn, and this is going to see if it's an actual support line. We have an initial test here. The price went up, came back to test again. And then lastly, we confirmed the third test, telling us that, hey, this area is a clear support line where buyers are preventing the price from going lower, so we should look at buying with the other buyers. As you can see, the stock went up, and it came back down support line again to where it could potentially take another trade. Next, let's look at resistance lines. A resistance line is a price level where supply prevents price from rising further. So this image shows a resistance line where sellers are stepping in. We had one test right at the beginning. We had another test where price came back up to that previous point and then sellers got control and the price went down. And we confirmed it with a third test, telling us that this is clearly a resistance line and we should always look to sell our stock if it gets to this price in the future. Now let's talk about the RSI. The RSI, or known as the Relative Strength Index, measures momentum. This tells you if stocks are overbought or oversold. The image below is the RSI, correlated with the chart that it's representing. There's 2 levels we want to worry about, the 70 and the 30. If the price gets to where the RSI has a score of 30 or lower, that indicates potential oversold value, and that's where you want to step in as a buyer. Vice versa, if the overbought value gets to a value of 70 or higher, you want to look at potentially taking that trade off and collecting your profits. You never want to enter a trade if you're bullish and you're trying to come in when it's already overbought. You always want to buy positions if it's oversold or if that number on the RSI is closer to 30. Remember, at the end of the day, if it's below 50, it's potential buy. If it's over 50, it's a potential sell. But you really want to maximize your chances by buying it when it's really oversold and selling it when it's really overbought. Now let's look at the MACD. The MACD is the Moving Average Convergence Divergence. It measures trend and momentum as well. This image below shows you how the MACD works. We have 2 different lines, the MACD line, which is the blue line, and the signal line, which is the tan line. Understand that a bullish crossover on the MACD is when the blue line crosses over the tan line, indicating a momentum shift. Whenever we see that momentum shift happen, bulls are potentially stepping in. If the blue line crosses below the tan line, that is a bearish cross, to where momentum is going to the downside. This tells us that, hey, sellers are really stepping in, we've lost our momentum in this trade, and we probably need to go ahead and take profit if we're already up. Understand that you need to wait for the confirmation. If you see that the lines are starting to start the cross, don't get in until the cross has actually happened. Longer term time frames on trading gives you a lot of time in this trade to potentially make a lot of money. However, if you try to jump the gun, you might get burnt out and you might actually take a loss because you didn't wait for a confirmed bullish cross or a confirmed bearish cross. Now let's look at a bull flag. A bull flag is a bullish continuation after a strong upward move, followed by consolidation. This is an image of what a bull flag looks like. As you can see, we initially had a bullish run, and then the price consolidated. If you look at the bullish run and the consolidation, it looks a lot like a flagpole and a flag. Eventually, price broke out of that consolidation range, and we had another bullish run to the upside. The second bullish run tends to be the same length as the first bullish run. So, you could say if this first bullish run was a $10 move, you could expect another $10 to the upside on the second bullish run. Bull flags are very powerful trade setups that if you can identify and you can actually use confluence with other trading indicators, you can actually catch these and make a lot of money. Now let's talk about the breakout term. A breakout is where price moves above a resistance or below a support with momentum. This image shows a resistance zone with a breakout that actually showed price going up and to the right. Understand that once we actually broke out of that resistance zone, the volume really kicked up and price skyrocketed. This typically happens around resistance and support zones because those supply or demand zones have had so many people constantly buying and selling. Eventually, either the sellers are going to lose or the buyers are going to lose. And in this case, the sellers lost because we broke through that resistance zone and the price skyrocketed. Because once there's no more sellers and there's only buyers, the price will continue to go up because of how supply and demand works. Now let's talk about pullbacks. I love pullbacks personally because this tells me a temporary move against the trend before continuation. This image below shows an orange trend line with pullbacks coming back to test that trend line. As you can see, whenever we come back from an upward move, that's what we call a potential pullback to where we can look to add to a position or hop in on a position. Pullbacks are used to identify resistance lines, support lines, uptrends, downtrends. They are the negative move against the overall direction of the stock trade. So when you identify these pullbacks, you could potentially find an opportunity to buy a stock and make money. Now let's talk about engulfing candles. An engulfing candle is a candle that fully engulfs the previous one, signaling a reversal. So, in this image below, we had a downtrend line identified by that orange arrow going down. And as you can see, we have a big green candle circled. Notice how that big green candle is bigger than the previous red candle right before it. That is a sign of an engulfing candle indicating potential reversal. And as you can see, the price started to set up an uptrend and go up and to the right, where we actually came back up to where we initially started. Now, let's talk about the VWAP. The VWAP is the volume weighted average price, or basically the fair value benchmark price. This tells you throughout the day, or throughout the year, throughout the months, a potential average price point that the stock has been at where buyers or sellers have stepped in to tell you that this is probably the fair value for this stock currently. Hedge funds and institutions love using the VWAP to get in on long-term positions to where you can plot their average price point where they think it's a fair value in the past. Understand if you see a VWAP going up, that means people think that the fair value is going up. So you could always wait for a stock to come to the VWAP. You could buy at the VWAP and you could cut your trade one deviation below the VWAP. That way you can always guarantee that you're going to get in on this VWAP, give it time to see if buyers are stepping in, and if sellers end up overtaking the price, you've set a stop loss, which will help protect your losses. Let's talk about stop losses. This is an order designated to limit a potential loss on a trade. The image below shows potential bullish trend. As you can see in the third touch point, we actually entered this trade. And right after we entered, you can see that this price went against us. But this purple line, notice how it's below the trend line as the trend line progressed upward. And it was just below our entry price, maybe by like $2. So we risked $2 on this trade. And as you can see, we did get a stop out, but we would rather take a $2 loss versus a $30 loss, because as you can see, the price kept going down after we initially flushed through that trend. So you should always look at set stop losses to ensure that you're protecting your capital when taking trades. You always want to risk more than you're trying to profit because that'll help you win more in the future. Now let's talk about risk reward. Risk reward is a ratio comparing potential gain versus potential loss. This image below shows technical analysis on a stock to where we had a bullish trend, break through a resistance line, found new support, which was the old resistance line, and then eventually tested the trend line again. So we traded it on that green arrow where we came back, tested the trend line again, already broke through a new range, and said, you know what, we're gonna set our max risk to be a flush below the old resistance line. Because if we're already taking a trade based on a breakout of resistance and a breakout of and a support of the trend line, then we want to make sure that our max risk is at least below that resistance line to ensure that we're giving the trade time to play out. As you can see, we risked a little bit to make a lot more. Notice how our risk box in red is smaller than our reward box. In this case, the stock did come back and test the resistance level, but it never broke through it. So our trade is still valid, and we were actually able to wait this trade out and take a nice profit. This is a great example of how to use technical analysis and risk reward to take trades. If you enjoyed the video today, join us at T-Signal where you can unlock your trading potential. Once you get premium access and become a member, you're going to be able to see real-time Discord alerts, you're going to get high-quality trades multiple times a week, see our monthly recap, and get tons of educational videos to help yourself become a better trader. Also understand that you can become an affiliate and you get compensated for other members you bring to the channel. That way we can grow and trade together here at T-Signal.